to be talking about 5 hidden tax strategies that you should start taking advantage of if you qualify, and how this can free up cash and for year end and for 2026. Hopefully you all know me, but I love talking about my journey. Ramona Cedeno. I am a CPA. I'm a certified financial planner. I'm the founder of Fibrick. I also wrote this beautiful book, which I just got very good feedback about. So if you haven't seen it, check it out on Amazon. It's not a commercial, but do check it out. And I have over 20 years of experience as an accountant and finance expert. I founded Fibrick 10 years ago, and my mission, my goal is to help small business owners build wealth. At the end of the day, I want all of you to experience financial freedom if that's something that you strive for. And as business owners, we have an advantage. We have a lot that we can do to improve our personal wealth. Also, live a good life, good work-life balance. And I think that the way we do that is doing what we love, but also earning enough or making our money grow. Today, we're going to talk about a few strategies that I want you to really consider before the end of the year. As I was hearing about the One Big Beautiful Bill, I thought to myself, what do I need to do? Ramona, personally, what do I need to do today to make sure that some of these strategies that are good, there are things that we don't love about the bill, but there are some things that are pretty decent, and I want to focus on the good. Today, we're going to talk about what is good in the bill that's going to help us as business owners and as taxpayers. And as I was talking about or thinking about what I could do for myself, do I sell my shares that I have in XYZ company? Do I contribute the max to my 401k this year? I always try to do that, but these are the questions that I go through. I was like, I need to do what I'm doing for myself, for my clients, and for my clients, I already do a lot, and we have one year-end meeting, which we're focusing on this particular issue, a specific issue. We do that regardless of what's going on with the tax laws. But I figured that I wanted to bring this content to people that are not my clients yet, and that's why we're here today. So what the bill is doing is allowing us to consider ways that we can keep more cash in the business. And one of the things that we are talking about as Fibrick and Ramona, as we're putting content out there, is that we cannot just focus on one thing. Okay, the tax rate went from X percentage to this percentage. What does that mean for me? It's not just that one item. It's how do we optimize our tax structure? How do we optimize our tax strategies to fall within that bracket that we want to fall under, to take advantage of a new deduction that we need that is available to us, but that depends on how much money we make. So we have to consider all the facts, what is the goal, and at the end of the day, it's all about cash flow, right? It's not just I'm paying a higher tax rate than the person next to me. It's how much money am I able to keep in my financials, in my business, which then I can use to grow or to invest and make more money. So I'm going to focus on bonus depreciation, which is available for small businesses, how you turn their innovation, their research and development. And I have someone here who is creating an amazing product. So this is strategy number 2 is applicable to her. And strategy number 3 today is how do you ensure that if you have the possibility of qualifying for the additional state and local tax deduction, which is that SALT item there on strategy 3, that if you're able to qualify for that deduction, you make sure that you do whatever you need to do to take advantage of it, because it translates to real savings. And why does this matter? Because when we have new tax laws, at the end of the day, we just want to make sure that we are paying the least amount of money in taxes, that we are timing the outflow of tax payments the right way, so that we can manage, or we can take advantage of the cash that we can keep in the books or in our financials to make investments and grow. So what is the real shift with this new tax bill? It's not just about the tax rates. I have been saying that on social media. If you're not following me, please go to LinkedIn or Instagram and follow us because I'm putting a lot of content out on this. The real shift is about the movement of money, and that's what I was talking about before. It's there is no reason in getting upset about why don't I qualify for this one thing. Maybe you qualify for the other five, right? Why is my tax rate 31%? Maybe you can reduce it to 25 if you make certain decisions that will allow you to reduce your taxable income. And that's what we're talking about today. Other things that are changing with this new bill, depreciation for small businesses. And I'm saying small businesses because that's who my client is. Some of this will impact large corporations, of course, but I'm speaking to my clients. Our small businesses can take advantage of some of these clauses in the tax law that allow you to, or provisions in the tax law that allow you to accelerate expenses, maximize some deductions, and depreciation is one of them. The new R&D rules, research and development. As a business owner and of a small business, you, believe it or not, have invested a lot of money. So you're investing money in research and development in some instances, and you don't even notice it. We think that research and development is for the large corporations. No, we are as small businesses. We are also making investments in this space, and you'll see how that impacts your taxes. And the last one I want to cover today is of what's changing is the state and local tax deduction amount. And I'll explain as we go through each of these, I will explain what they are. If you have any questions, are you able to, let's see if you're able to put them in the chat because I would like to answer. If you're able to put them in the chat, please leave them there and I'll check at the end of the webinar. And if I don't get to answer your questions, I will email you the answer. And you also have the opportunity of scheduling an appointment with us. You'll see that at the end. So the changes in depreciation, R&D, tax rules, the state and local deductions, they impact liquidity, money, the timing of your cash flow, and how this cash that you're saving is going to help you propel growth in your business next year. Let's talk about bonus depreciation. What is this? Okay, so I am going to explain it in case some of you are not familiar with this term. So I'm going to give you the accounting depreciation 101. In taxation and in accounting, if you buy a piece of equipment that is expected to live for more than a year, a computer, a car, in most cases, you are required to expense that item over a period of time, over the useful life of the asset. So if a car useful life is 5 years, you would typically have to expense 1/5 of that cost a year. And there are rules. The IRS has specific rules around the useful life of each of the equipments that exist. And the accounting guidelines also have their separate rules, which are different from tax in some cases. So what the bonus depreciation provision does for us is that it allows us to accelerate the depreciation, the deduction of a piece of equipment in the same year that to be 100% deductible in the year that you acquired it and put it into use in service. So the idea is that you acquire the asset this year, 2025, you put it into use in 2025, and under this provision, your business might be able to take the deduction of that purchase 100% in the current year. As everything, the IRS and the tax laws have different exemptions and clauses that we have to take into account, whether the business has to be profitable, the type of equipment that qualifies, different areas that we have to focus on as we do the analysis. But at a high level, equipment, cars, technology purchases, computers, furniture, and software. Some of these costs you can accelerate in 2025. There is one new addition to this, which is very interesting and might not apply to a lot of us here, but this bonus depreciation doesn't apply to real estate property, with an exception now, and that is if there is a building that is used for manufacturing companies now may be able to accelerate the depreciation of a real estate property. And that is like huge. That was never seen before. I mean, at least not in my lifetime. So that's going to be very big for people that of business owners in manufacturing. So what should you do today to take advantage of that? You might say, and you're right, it's like, okay, this I have to buy equipment in order to take advantage of this provision, this depreciation deduction. And you're right, you have to invest in order to take advantage of this. So what I say to my clients is, think of equipment that you have to buy anyways next year. If you have to buy a computer, if your computer is almost, dead, you have to switch, change it, buy it this year so you can take the depreciation this year. There are other things that I ask my clients to consider. If this year you're already at a loss, your business is losing money, and you expect your business to make money next year, maybe this year is not the year to buy that computer. Leave it for next year. So that's when planning and advisory comes into play. It's not just making the decisions rashly, it's taking into consideration how it impacts everything else in the business, but also is the timing right? So if you do have to buy equipment next year, your business is profitable this year, you have the funds to invest this year, this is a good opportunity for you to take advantage of this new provision. And what's new about this in the bill is that this the bonus depreciation was scheduled to expire in a few years. It was going to be phased out over the next few years, and clients or taxpayers are going to lose this opportunity, but now it has been put back, which is great. So this is how it'll work. If you have to buy a piece of equipment that's $100,000, your estimated tax rate is 25% federal, 5 state. These are all estimates. Your tax rate might be 20, might be 30, but I usually use 20 to 25. And you buy this piece of equipment this year, you are saving in taxes $25,000 at the federal level and 5 at the state level. So that's $30,000 that you're saving. Now I'm using big numbers, but this could be $10,000 and you'll save 3,000, right? And net, you still have to invest the 100,000, but because of the savings of 30, your net cash outflow is 70,000. If you waited until January, you would still have to pay the 100,000 for the asset, wait until the end of 2026, at the beginning of 2027 to see the saving from this. So again, take into account the timing. Now let's talk about R&D credits and R&D deductions. Do I have a spelling here? I don't know. I don't remember now, but that's funny. Turn innovation into tax credit. So the research and development provision allows taxpayers now this year to deduct 100% of the R&D spend in the year that you invested in research and development. But in addition to that, you are potentially eligible to get a tax credit, a dollar for dollar tax credit on R&D. Now, there are qualification requirements, there are industries and type of work or research that you need to be in order to qualify for the credit. The deduction, if it's a business necessity and is a business reasonable expense, you still get your deduction for R&D spent, but the R&D credit is a little trickier, and you do have to qualify for it and go through an R&D study. But what's different now is that prior to 2025, a business owner would have to capitalize the R&D spend, which means put it on the balance sheet and not be able to take the deduction all in the same year. So that's what's new. Now you can expense, deduct 100% of the R&D cost in the year that you incur them. And separate from that, you might qualify for an R&D tax credit. So this is big for businesses that invest a lot in R&D. This qualifies for improving a product or process. You are creating a new piece of technology. You're testing, experimenting. All of those costs are eligible for the R&D deduction and credit. And of course, all of this has to be looked into for your particular situation, your business, your industry. Does it make sense to invest the money that you have to invest to get the R&D study for the credit? The R&D spend deduction, that's just like any other expense that you incur. No need to evaluate whether it's R&D or not. But if you want to qualify for the R&D credit, that requires a little bit of extra work. There are some exceptions, like cannabis wouldn't qualify. The activity cannot be purely operational. So if you're doing something just to run your business, that would not be considered R&D eligible for the tax credit. And there is a difference in treatment for whether the R&D is incurred in the U.S. versus foreign for the tax credit purposes and for capitalization. The U.S. is encouraging investing in research and development within the U.S. So the treatment for anything that you do outside of the U.S. is different from an expensing deduction perspective, and also from for tax credits, it would not be eligible. You still get to deduct the foreign R&D, but over 5 years, not immediately. And in terms of the R&D credit, the foreign spend is not going to qualify. So what do you do now before the end of the year? It's very important to identify what R&D, research and development, have you invested in? Is it domestic? Is it foreign? Is it from employees or contractors? Because employees and contractors get a different credit percentage. Identify this in your P&L, profit and loss statement, classify them separately so that it's easier for you to then go back and have a conversation with your tax advisor, and set up a process for 2026 if you didn't have this set up, where you're tracking your R&D spend separately in the P&L to make it easy next year. And if you want to see if you qualify for the R&D tax credit, you will discuss this with a tax advisor to help you conduct an R&D study. So just to summarize here, the R&D spent as a deduction in your P&L and tax return is a separate process. That's just your normal accounting. But the R&D tax credit is it requires an R&D study or analysis to determine what qualifies for that dollar for dollar credit. And I'll walk you through some examples now. So let's say you have an employee that's working solely on R&D activities, and they are in the US, and their salary is $150,000. You have an R&D, you have a foreign contractor that gets paid $80,000 to work on your software development or your prototype. They're doing R&D work. You also have someone in the US that's a consultant, not an employee, that is generating $120,000 in fees. How does this impact your P&L and your taxes? From an expense deduction perspective, let me go back here from 1 second. Okay, from an expense deduction perspective, your labor is deductible. This is an expense in your P&L and your tax return. Your domestic consulting is a deduction immediately. $120,000 gets deducted in your P&L and your tax return. The $80,000 is going to be parked on the balance sheet, and every year you're going to get 1/5 of that into your P&L. So that's from a deduction expensing perspective. But now let's talk about the tax credit. The R&D tax credit has been around for a while, and it's depending on the life, how long your company has been in business and whether it's profitable or not, the R&D tax credits can be used to either offset payroll taxes or income taxes, corporate income taxes. So that's the piece that I'm going to talk about next. Currently, you can get up to one $1 out of $10 invested in domestic R&D. So that's equal to 10%. So the R&D credit on 150,000 would be $15,000. The R&D credit on the foreign is zero. So you see the distinction? You can get the deduction of 80,000 for foreign R&D over 5 years. You're going to get 1/5 of that into your P&L, but you don't get the tax credit in addition to that deduction. The 120 for consulting, you don't get 10% because it's consulting. You get 85%. So you get just 0.85 cents on every dollar. Now, this is the credit. This is not the deduction. Now, the deduction gives you your whatever tax rate times the total. And what's different, whatever tax rate you fall under times the total spend. What's different this year is that prior to 2025, again, these deductions would not have been possible in the same year that you incur them. Right? So these two are deductible now in the same year that they are incurred. This one is over 5 years. The 80,000 for foreign hasn't changed, but the domestic, now you can take it all in the year of expenditure. In addition to that, you might qualify for a tax credit. There are some other things that we have to do in the tax return if you are taking the credit. Like, for example, if you get a credit of 25,000, you get a dollar for dollar credit. That means that your tax bill, your payroll tax bill will be reduced by 25,000. But you also have to adjust your P&L by 25,000, so there is no double dipping. But the credit gives you the best benefit. And I know this is a lot, so that's why I encourage you to schedule an appointment with me so we can do it one-on-one. But just to summarize that, a tax credit is going to reduce your bill by that amount, 25,000. You would have to increase your expenses by 25,000, but net, you are better off with the tax credit if you do qualify. Please type your questions. I'm going to pause because I think I'm going really fast, but it's because I'm looking at my clock and it's like, oh my gosh, I scheduled this for 30 minutes. And the reason I did this is that I was trying to see if people like the idea of 30 minutes, and I would like for you to put that in the chat if you're able to chat or email me. I was hoping to get more interest by scheduling a 30-minute session and a 30-minute session next week, and you can choose which one you go to and see if people felt like, oh, this is better. I can spend 30 minutes of my day listening to talk stuff. But now I feel like I'm going through it pretty quick, but I'm learning. I will learn from this, and it's probably just a matter of reducing the content or speaking less. But I welcome the feedback. Now let's talk about the SALT. This is my favorite. This is my favorite. For those of us and also of you who own properties like homes and you have property taxes, or you live in a state with very high income tax rates, this is going to be a good one. So if you itemize in your personal tax return and don't take the standard deduction, if you itemize because you have enough deductions that put you over the standard deduction, this is for you. So let me give you an overview of the standard versus itemized. So standard deduction means that every taxpayer does not pay taxes on the first X dollars of income at the personal level. And for single, that might be, for head of household, that's about $20,000, let's say $20,000. So if you're a head of household and you make $100,000 at the personal level, you don't pay taxes on the first 20, and I'm rounding, you pay taxes on 80. That's the standard deduction. Married filing single, married filing separate have their own deduction, married filing jointly have their deduction, single have their deduction. Everyone has their amount or portion of income they don't pay taxes on. Itemized deductions means that if you have property taxes, state income taxes, charitable contributions, mortgage interest, when you add all those up, if those numbers are more than your standard deduction, you want to itemize because it will give you the best tax saving. So imagine if you're head of household and your standard deduction is 20, but now you have mortgage interest of $40,000, you would want to itemize because the 40,000 means that you're not paying taxes on 40,000. Okay, up until last year, between 18 and 2024, the tax laws only allow you to deduct up to 10,000 of property taxes and state income taxes combined. Prior to 2018, it was whatever you spent in those two items. But between 18 and 24, you can only deduct 10,000 of your state income tax and your property taxes combined if you itemize. So that means that you would only benefit from itemizing if you had state income taxes and property taxes of 10, because that was the max. Your interest on your mortgage will have to be pretty significant for you to get above that standard deduction. Well, this year, the state and income tax and the property tax combined cap amount is $40,000. $40,000. So for those that live in high property tax states and they're paying $25,000 in property taxes and $15,000 in income taxes, well, that would be great. They can deduct 40 of this. That means no taxes on 40,000. Here are a few things I want you to keep in mind. If you're a single head of household, it's 40,000. If you're married filing jointly, it's 40 for the couple. If you file separately, it's 20 per person. So don't think that if you are filing separate from your husband, you're gonna get 40, or from your spouse, or you just get 20, okay? So that's something to think about if you are considering filing separately. And this is the catch. Your taxable income must be under $500,000. Okay. Now the planning comes in when you say, okay, I don't have a home. My state taxes are only 5,000. I don't have to worry about this, right? Or I'm generating $510,000 this year. Remember, it can be combined income. This might seem like a lot for some people, but with your spouses, it might be a significant amount, right? So if you are at that borderline, 520, then okay, what can we do to bring it to 500? And that's when the planning comes in, because as a business owner, you can spend down some of your net income this year so you can qualify for this deduction. And if you have a pass-through entity, you can take advantage of the pass-through tax and pass-through entity tax, which a lot of states have in place. This is a little more, takes a little more explaining, so I'm just going to throw that out there and you can research or reach out to us. But the states put this provision in place when the SALT was reduced to 10,000. A lot of states jumped in and gave small business owners the ability to deduct more state taxes through the companies. So now that the SALT was increased to 40 and we still have the pass-through entity tax, some of the small businesses can double dip there. So, but that, reach out to your tax accountant advisor for that. And tips: lower your AGI, adjusted gross income, invest in your business this year, but always analyze, plan, get advice before you make these decisions. You have a month or less to do that, okay? And compare the benefits of married filing jointly versus married filing separate if you are considering one versus the other. And this is how this works. If you can take advantage of the 40,000 SALT deduction, your tax rate is 25%, state rate is 5%. That is a tax saving of $40,000. So you just look at the numbers. No, $40,000, 12,000, sorry, I jumped. So 40,000 times 25 at the federal level is 10, and then 40 times 5% is 2. So total savings of 12,000, no 40,000. And if you have the PTT election, the pass-through entity tax, then you can increase your deduction this year. Now let's bring it all together. I'm not saying that this is going to apply to any single taxpayer all at once, but let's say that there is a possibility. If you have to buy machinery, you have R&D spent domestically, your adjusted gross income is below 500, which means you qualify for the 40,000 state and local deduction. Your estimated tax is 25. So we do the math. And if someone was in this situation, there'll be a total savings of 47,000. Now you can bring these numbers down, make them 10, 80, 20, whatever the number might be, you still get to save. So just because I like big numbers, it doesn't mean that the savings is still not significant compared to what you would have paid otherwise. And I can share these slides with all of you and the recording. So if you maximize your bonus depreciation, you have R&D spend that you're investing in for innovation, and you take advantage of that state and local tax deduction this year, that just means more cash in your bank account. And we will be happy to talk about this with you if you want to schedule a call. Here's what we have for next week, because we're having a part 2 of this webinar. We will talk about 2 more strategies to consider. And I want to talk about the qualified business income exclusion. Some of you might know about it, but I wanted to prepare to take advantage of it. How you turn these rules into growth readiness, and what's coming up for 2026. I wanted to focus on what you need to do immediately, but there are some things that you may want to consider now before the end of the year that will impact 2026, or even the things that you can do in January, February to take advantage of the new tax provisions and the new tax bill. And you can schedule a consultation with us. Here is the book now QR code, and you can email me too. So there are 2 ways to consult with us. One is if you want us to look at your financials and your income, estimated income as they are today, and you want to explore whether some of these provisions can be beneficial to you in 2025, you can schedule a paid consultation, which is super discounted for this month and the beginning of December. The standard free consultation for you to explore whether you want to work with us is also available. So there is one that's paid where we'll actually be looking at your numbers and giving you some feedback, a little bit of tax strategy planning. That is paid, but it's discounted. And the other one is free, but we just talk about how we can help you and learn a little bit about your business, and then you can make a decision on whether you want to work with us